welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman alongside Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Just because we're in that seasonally weak time in the market, August through October, I think that the August lows of 51.16 are likely going to be tested again, which means that, as an investor, as a long-term investor, you just need to be a little bit cautious.
Not ready for prime time. Look, in fairness, Gen AI is 15 months old. And the best apps on the Apple iPhone are made by third parties, not by Apple. So this is just too early. They're not even going to have Apple Intelligence on the phone at launch. I just think there's no compelling reason that somebody should run out and buy a new iPhone 16. You should wait for the 17 because it's going to have either cooler stuff and there'll be more Gen AI capability.
In large part, this debate is going to end up being a contest of who can define the other candidate as the bigger risk. Harris certainly is the candidate that voters are heading into the debate with more questions about. So Trump is going to be trying to characterize her agenda and her record as radical and far left and out of the mainstream, out of step with voters' values. She is going to, try to explain this much more moderate agenda that she's running on now relative to where she's been in the past in terms that can connect with voters.
We got 1 hour to go until the market closes, and we're taking a look at the major averages here. So we got a stalling of the rally that we had yesterday, although we have seen a turnaround for two of the three major averages, but a little bit of loss of momentum earlier. We've got the Dow now down 120 points, about a third of 1%. The S&P 500 up a third of 1%, but as you can see, it's been bouncing around quite a bit today. And the Nasdaq now up 2/3 of 1%. It does feel like volatility is ticking up a little bit. We've got the debate tonight. And even though, traders haven't necessarily zeroed in on the presidential election, maybe it's causing a little bit of an uptick in volatility. Today, vol is down. But if you look in the last, call it 3 months or so, of course, we had that volatility spike, and now it's creeping up again.
Yeah, also maybe a little wait and see, Julie, because we do have that inflation report tomorrow. I mean, we talk a lot about how the street seems to have moved on to economy and labor market. But, you're waiting for that inflation print, how the market reacts, how the Fed reacts.
Yeah, definitely. Something else we're watching today, oil prices, and that's because we continue to see oil under pressure here. WTI off by about 3% here. Brent also taking a tumble. And there's been a lot of pressure on oil prices. A lot of different folks on the street have been downgrading their forecasts.
Yeah, I mean, listen, the theme here of the story has been the demand picture. And specifically, and we've talked to a lot of smart oil analysts about this, what they see is a potentially kind of weak demand outlook for China and the U.S.
Yeah, OPEC didn't change its demand forecast, so that's something to note here. The IEA, the International Energy Agency, is going to come out with its monthly report next week, so that'll be something to watch. Something else to watch is a new hurricane that is coming to the Gulf of Mexico. Now, normally, a hurricane is approaching and you see prices go up, but that's not happening yet. Maybe people are just waiting to see what kind of actual effect that hurricane will have. The third theme that we are watching that we want to highlight is what's going on with the banks.
Yeah, I mean, to me, it was almost like there was two real kind of themes, sectors I was watching. One was tech, and you point out, you could see the Nasdaq outperforming today. That's Oracle, just ripping and surging. The other was the banks, because we did get this morning, it was interesting, I had the headline, new capital requirements. You thought that maybe would have put a smile on some traders' faces, but I think other comments by some bank execs just kind of weighing on sentiment today, for sure.
Yeah, exactly. The capital requirements from the Federal Reserve going to be 9% in terms of the amount they have to increase the reserves against losses. Originally, that plan was something like 19%. There was some suggestion maybe that was priced in, but there's also a Barclays Financial Services Conference. And at that conference, JPMorgan President Daniel Pinto said, the street might be a little too sanguine.
A little too rosy with their projections.
Rosy about net interest income and about expenses. And so we saw the stock fall on that. That on top of Goldman Sachs also coming out and talking about trading being a little challenged. It's taking a write down still on its
Trading
consumer
revenue
business.
on track to drop 10% in the third quarter.
Exactly.
Yep.
So seeing the banks broadly under pressure today.
All right, well, let's get more perspective on this. For more on the latest moves, I want to welcome in now Mark Newton, Fundstrat Global Advisors, Managing Director and Global Head of Technical Strategy. Mark, great as always to have you on the show. I want to pick up right there, Mark. I was talking to Julie about the big banks, front and center for investors today. You had bank executives making headlines, Mark. I'm interested as a technician, you're looking at the charts for the big banks. What are they telling you here?
Well, let's not forget, Josh, that banks were up about 10% over the last 3 months. It was one of the best performing sectors in the entire market. But it's always important to keep an eye on the financials. I mean, they're literally the second largest sector in the S&P behind technology. So, you heard reports of JPMorgan, net interest income could be a little lower. Trading revenue being hurt on the fixed income side as rates have pulled back sharply. I don't view this sector to be in all too much trouble. Technically speaking, I mean, it's still been in excellent shape. Yes, we do see a minor pullback, but that's on the heels of really robust gains in this sector over the last few months.
And so let's broaden it out a little bit and talk about what you're seeing in the market. I know you've been watching the S&P equal weight pretty closely here. And we've been talking a lot about the broadening that we have seen in activity. What is that? What are the implications of that for the sustainability of stocks going higher?
The implications are simply that the market's not nearly as weak as what people expect and what they think. I mean, everybody has their eyes on technology for good reason. It's 30% of the S&P, but when you see 5 sectors hit new all-time highs at the end of August, that being technology for one, financials, healthcare, industrials, and utilities, that's a sign of a pretty healthy market. So yes, we do see tech slipping. We've not broken down substantially enough to think the tech is broken. That's the one thing. Certainly in a new era of cross-asset volatility that investors are trying to get their heads around. It's really been FX, honestly, and what's happened with interest rates, much more so than the equity market. But it's always difficult to lose 4% in the S&P over the last week. When you start off a month like September like that, historically, that is troublesome. Normally you do have an average of about a 2% decline for the month. We are in an election year, of course. Seasonality dictates that normally this is the time that markets are weak. And so we expect to see a little bit of a pullback. The question is, is it a minor correction or is this the start of a major big deal? I would argue that given the fact that sentiment is really not that optimistic as I would want to see at a market top and the breadth remains better, it's going to be a hiccup. I think, normally election years are great. We have this huge amount of contentiousness and divisiveness regarding the election, of course, 2 wars overseas, a lot to get us unhappy about. Earnings, though, have been remarkably good, and the stock market itself has been good. So, let's not get too bent out of shape about, granted some understandable major pullback in some of the semiconductor stocks. I don't think it's been damaging enough to say that the market has peaked out, honestly. But it is an uncomfortable time for many investors. Sure.
So Mark, if the SPX here is at 54.88, what would be your year-end price objective?
I do suspect we probably pull back a little bit further, even over the next week, as you can't rule that out. So maybe to 53 and change. Then I think we probably start to turn higher after the Fed meeting. Tomorrow's data, as you mentioned earlier, Josh, is important. Fed meeting, very important. Right now we're pricing in about a 35 basis point cut. So right in between 25 and 50. 50 would likely be seen as too much. And historically, when that's happened, 2007, 2001, that's been troublesome. My thinking is the market ends the year probably at 5,800 or higher. And the best times of any election year typically tend to be buying weakness into the election, November into next spring, really should be the sweet spot for investors. So if you want to make money in this day and age, in this time period between now and the election, you have to be very well diversified. Healthcare, I would even argue financials, JPMorgan at $200 is a steal. In my view. But really, utilities, REITs, gold looks very, very good, but you have to be diverse. You can't just be 100% in technology, unfortunately, or if you do, you have to watch that very carefully. And after the election, I think we'll have more of a broad-based recovery where everything works between November and next spring.
Now, I want to circle back to something you said. We were looking at the VIX before, kind of ticking up a little bit, but other assets we have seen more volatility. The MOVE index, which is bond volatility, moving up a little bit. We're also seeing the dollar volatility creep up a little bit. FX, you mentioned. How is that interplay sort of working with stocks, and what does that tell us about sentiment out there?
Well, there's a couple of things to mention. One is that the positioning in the yen has actually grown a lot more bullish in recent months. And it's gone from really one of the most negative levels on record. We've seen shorts that are now back to really quite positive, the positive in the last couple of years. So that means that this whole unwind carry trade likely is not going to be able to continue. In other words, people borrow cheaply in yen to maybe buy tech stocks. Now they're forced to liquidate as the yen goes higher. The yen has a very sharp, serious floor around 140 dollar yen, in other words, a floor. So I expect to see a little bit of a bounce. We've already started to see that in the dollar as Trump has started to talk about potential tariffs. So the dollar has stabilized, has started to turn higher. The volatility is, a source of major discomfort, I think, for everybody across, all asset classes. But I sense that, we're nearing a time when bad news is no longer going to mean good news for stocks. The economy has started to weaken along the fringes, not major weakness, grant you, but the labor market has seen weakness. So, yields have already pulled back very, very sharply. My thinking is yields and the dollar are close to a short-term floor, which means, further deterioration in economic data likely would be more of a negative than a positive for stocks. Yields likely bounce, potentially starting tomorrow, potentially next week, after the Fed unveils its plan. We get more clarity, and then, we probably see a little bit of a rally between now and into October. But, granted, we're in a dicey time. Historically, it's been difficult when the S&P does lose ground the first 4 days in a very rapid session, being down 4% on the first week of September. Very, very difficult to get our heads around what's moving, but a lot of it is technology. And if investors take the time to research, all these other sectors are acting phenomenally well up until the last couple of days. And like today's weakness in financials is really a drop in the bucket. It's not the signal of a major top in financials, in my view. Banks are going to be able to weather this, but rates have been headed lower for the right reasons. So.
JPMorgan at $200 a steal. We got a bank analyst on later. We're going to have to ask him if he agrees.
We're going to
with
buy
you.
him, Mark, see if he agrees.
Yeah, exactly.
Absolutely.
Good to see you. Thanks for
Likewise,
coming
thanks,
in. Really
Julie.
appreciate
Thanks,
it. Well, we're just getting started here on Market Domination. Coming up, our coverage of the Goldman Sachs Communacopia and Technology Conference continues. We'll be hearing from Lyft CEO David Risher, as well as Hasbro CEO Chris Cox later in the hour. Stay tuned. More Market Domination still to come. Let's get to some of today's top trending tickers. And throughout the trading day, you can track the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. You can scan that QR code below in order to check them out. Now, starting with taking a look at Ally Financial, those shares sinking after the bank's chief financial officer warned that credit challenges have intensified. Remember, we were talking earlier about the Barclays Financial Services conference? Well, yet another piece of commentary coming out of that conference that is hitting a stock. In this particular instance, it is auto lending. That's what Ally does a lot of, and that's where they're seeing the deterioration. Yeah,
this is the CFO talking, and at the Barclays conference, as you know, Julie, how borrowers have shown signs of vulnerability throughout the year, saying over the course of the quarter, our credit challenges have intensified. Our borrower is struggling with high inflation and cost of living, and now more recently, a weakening employment picture as well.
Yeah, I thought the commentary from Sanjay Sakrani over at KBW was really interesting. He said, clearly the guide was disappointing. He says, this begs the question if this is Ally specific or a canary in the coal mines. And we were talking earlier about JPMorgan's comments as well, Goldman Sachs's comments, add Ally onto that. And you see the sort of spreading declines across the banking industry today. You know, it's sort of a cumulative effect of these various companies making these commentaries.
Yeah, and I did see analysts who cover the names citing reports saying they did think the firm's guidance was going to change, predicting the outlook for net charge-offs was going to increase, and that stock is just getting whacked today. Yeah. Moving on, the next trending ticker, Sirius XM, kicking off a new chapter as an independent public company, announcing a $1.17 billion buyback program. The broadcasting company also slashing its free cash flow forecast for the full year. Stock's popping about 4%. So the board, Julie, does authorize a $1.17 billion common stock repurchase program. Comes a day after Liberty Media and Sirius Media completed the split off of the Liberty Sirius XM holdings. Dow Jones, the newly authorized amount represents the amount that remained available under former Sirius XM's $18 billion stock repurchase program.
Anytime John Malone is like, I'll be perfectly transparent. I found this transaction confusing, right? So basically what happened was Sirius XM shares combined with the Liberty Sirius XM tracking stock group. That's what this transaction was. So I don't know what makes it a newly independent company, because Liberty Sirius XM shareholders own about 81% of the company, and former Sirius XM minority shareholders own the remainder.
Would it help to get John Malone on the show?
John Malone, please come and explain all of this to us. But the company also seems to have cut its free cash flow forecast for the full year, so that appears to be why the shares are under pressure, I think. All right, let's talk about Hewlett-Packard Enterprise. Those shares are sliding after it announced a public offering of mandatory convertible preferred stock. When you have more shares coming out there, it can dilute the value for existing shareholders. Why is Hewlett-Packard Enterprise doing this? Well, it is buying Juniper Networks, and so it is raising some cash in order to do that, but with the knock-on effect of the shares being down.
Yes, to pay related fees and expenses, and if any proceeds remain thereafter for other general corporate purposes. Remember, HP did recently report earnings results too, Julie. We broke those. Be on the top and bottom, analysts pointed out, like rivals, it had not been insulated to gross margin pressure from those AI servers. Stock now, by the way, now in the red year to date as well.
It is, and it announced that acquisition of Juniper, by the way, back in January.
14 billion, I think. Was
14 billion. Yeah. It could close at the end of this year or maybe early next year.
All right, moving on. Day one of the second antitrust trial between Google and the Department of Justice is in the books, and this time DOJ wants to break apart Google's online advertising businesses. Here, breaking it all down with us is Yahoo Finance senior legal reporter Alexis Keenan. Break it down, Alexis.
Yeah, so I was in court yesterday, so day one of this second antitrust trial against Google in the past year. And it's about online advertising. But if you ask the DOJ and you ask Google, what is this market? They don't agree at all. So the DOJ would say, well, this is a group of niche markets. It's a big market and has all these counterparts. You have the publisher side, the adversary side, and then the exchange in between. Google would say, no, not at all. All of online advertising is one big market, one two-sided market where these parties operate, and that should include display, social, streaming advertising. And who does that pull in? That pulls in pretty much everybody. You've got Microsoft, Meta, Amazon, even Yahoo, right, that operate in this territory. So Google wants them all in. Why? Because it makes their argument easier, because then they can say, look, we have all this competition in this market. So the DOJ, for its part, saying, no, these ad tech markets exist. And what they did is they put up 4 different executives on the stand, 3 of them founders and CEOs of companies that operate in these more niche areas, one on the publisher side, one on the advertiser side, and one on the exchange side. And they all said they view these markets as distinct. And so that bolstered the DOJ's argument. Now, they're the ones who get to put on their case first. The government does. So we haven't heard from Google yet, but for their opening statement. So Google, though, would say, look, the cost per click has gone down. Publishing ad revenue is up. This is a 24 to 30-some billion dollar a year industry that's pulling in money for publishers. So it's going to be a tough argument once Google gets up and makes that argument, because the bottom line here is harm to consumers. That's what the judge is going to care about. Are consumers being harmed in all this? And if not, no problem.
When you talk to various legal gurus, Alexis, legal experts, and bottom line, you ask them how strong is the government's case, what do they tell you? Like strong, weak, confusing?
Confusing for sure, that top comment. But I would say I have comments on both sides where some antitrust experts think this is a really strong case, because they say if Google is able to tie together all of these markets in which it operates, that it can inflate prices, even if that's a penny, even if that's half a penny, that they can do that and customers have nowhere else to go. That's the argument, is that there's a tying argument here, a little bit complicated. On the other hand, if consumers aren't harmed, if Google can make that argument that this is for the benefit of everyone involved, then the judge is going to have to defer to that and say that's a win.
Well, we'll see what happens. It's the beginning of a long process, I'm sure.
Yes, none of this will come to pass so quickly, so we have some time to think about our investments.
All right, thanks, Alexis. Appreciate it. Well, D.A. Davidson initiating coverage on Meta and Alphabet in a new note this morning. And the analyst saying that he is adding the names to the compute sector coverage. We have the analyst behind that note joining us now, Gil Luria, Managing Director at D.A. Davidson. Gil, it's always great to see you. I found this note interesting because, as you point out, you unite a bunch of companies that are usually not covered by the same person at shops like yours. And you're putting them under that umbrella of compute. Just briefly, tell us your thinking in putting them all together.
Yeah, these 6 companies are really providing most of these compute capabilities in the market. And especially over the last couple of years, they've taken in almost all the profit growth, which is why they've performed so well. And in the next markets they grow into, which is AI compute and spatial computing, those markets require scale, reach, and capital. So unlike previous waves of technology innovation that came from startups, innovation now is coming from these biggest companies. So these 6 companies will continue to dominate in AI, in spatial computing, and extend their lead from the sectors they're already in, desktop and mobile computing, cloud computing, and advertising computing. They'll keep dominating those, and they'll dominate the next 2 waves.
And interesting, when I think about Meta, and you initiate there, Gil, with a buy, one interesting thing I'd love to get your take on is you clearly saw in this earnings season, big tech investors has kind of renewed skepticism about all this AI investment. It seemed to be this theme of show me the return, show me the ROI. With Meta, though, it seemed to be different, Gil, where analysts seem to believe, listen, all this AI investment is actually showing improved engagement and advertiser ROI. Is that how you're seeing it?
Absolutely, and Meta's not getting the credit for it. They're trading at a below market multiple, while the other components, so Microsoft, NVIDIA, Apple, are all trading at above market multiple towards the higher end of their multiple historical ranges based on the notion that they'll win from AI, which they will, where Google and Meta are trading below their traditional multiples, meaning the market's not giving them any credit. Now, we think for Meta, as you point out, AI is already working in their favor. They're better at delivering ads. They're getting higher yields on ads because of AI. So that investment's already working for them. And we point out that they're carving this very important market for open platform AI compute. So while Microsoft, OpenAI, Google Gemini, and Amazon Anthropic are fighting for the ground of having the closed source model that they control, Meta's gone the other way, which is having an open platform that people can use their Llama model, continue to improve it, and to your point, Meta continues to benefit from that. And based on the multiple, they're not getting credit for that.
So while Meta is different than the others with that open source model, it is very similar to the others in that it is spending a lot of money on data center build out on NVIDIA effectively. And you call that a sort of wealth transfer of the hyperscalers to NVIDIA. Where are we in that cycle, if you will, that flow of investment? And when is it going to stop? What is it going to look like?
What's clear is that they can all win. They can all grow their cash flow at the same time as NVIDIA. Either these companies at some point get to a point where they say, we have enough capacity, let's digest it, let's get some good returns on it, and then get back to cash flow and margin growth, or they continue to transfer wealth to NVIDIA for the foreseeable future. That's what the stocks seem to imply, is that this is going to continue forever, and these companies will be unscathed. We don't think that's likely. We think there's going to be a point, likely next year, maybe the year after that, where all these companies, one after the other, say, we've done this huge build out of data centers, let's digest it, we can stop buying GPUs for a while, or let's use our own GPUs for a little bit longer until we get that ROI.
So, Gil, you initiate Meta with a buy. Not as much love, though, for Alphabet, Gil. There you're on the sidelines. You initiate there with a neutral. How come?
Well, let's contrast what we just said about Meta. So in terms of positioning for the future, Google is going to be in a fight with the other closed source providers for foundation models. They're no longer really competitive for spatial computing. And for them, AI appears to be more of a headwind on their core business. You just had this great conversation with Alexis about what the DOJ wants to do. The DOJ has come out and said, hey, Google has 90% share of search. The search market is changing. We're going to go to Gen AI enhanced search. We don't want them to have that same share of the next generation. So regardless of the quality of the case and whether the DOJ can pursue it successfully, they're making a statement that they don't want Google to have the same share at a time where the market is transitioning and new competition is coming about from your ChatGPT, from your Perplexity, and others that want to take a bigger piece of this search with generative AI incorporated into it.
And finally, Gil, I want to ask you about a company that you're not covering, that you explicitly say you are not covering. You say, well, I'm putting the Magnificent Six in my coverage universe now. But there's one stock that you say is not like the others. And I had to say it made me giggle at the end of your note, summary, where you talk about that. Tesla. Why don't you view Tesla as like these others?
Yeah, more than 90% of Tesla's revenue and profits come from making cars. So they're in the car market. The fact that they have potential for doing other things in the future is great, but that's a venture investment. Right now, they're in the car business. Having said that, the player here isn't Tesla, it's Elon Musk. When I say that Meta has a big lead in terms of pursuing the next open platform foundation AI model, the second in that running is Elon Musk's Grok that he has under XAI. And if he continues to commit his personal resources to building that out, he can be competitive there as well. But that's not Tesla. That's an investment that's actually more part of Twitter and really an Elon Musk investment as opposed to a Tesla investment.
Gil, always love having you on the show. Thanks for joining us.
Thank you.
Coming up, we're heading out to the Goldman Sachs Communacopia and Technology Conference as our very own Brian Sozzi sits down with the CEOs from Lyft and Hasbro. Stick around, you won't want to miss those chats.
Welcome back to Yahoo Finance. We're still out here in San Francisco at the Goldman Sachs Communicopia Conference, holding it down, talking some AI, and let's talk some rideshare now. Lyft CEO David Risher. David, good to see you again. Weren't we just
Good
here?
to see you, Brian. I think it just was a couple of days ago, or was that last year?
Yeah, maybe. Either way.
Yeah.
But good to see you nonetheless.
Thank you.
So last year when we talked to you, you were still getting your plan in place,
Yeah.
thinking about what you're going to do for the next 12 months. Is Lyft still in that turnaround mindset?
It is. It is, but it's at a different stage. So a year ago, it was really about reorienting the company towards customer obsession, right? And this is sort of my thesis. You've heard me say this 1,000 times. Customer obsession drives profitable growth. So what does that look like over the last year? We've lowered prices. We've gotten our driver pay in line. We've launched Women Plus Connect that allows women riders and drivers to choose each other. And that's produced growth quarter after quarter after quarter after quarter. We just announced last quarter our first profitable quarter, which was fantastic. We've got more drivers on the platform than ever. We're doing 2 million rides a day, 800 million rides a year. So all that's great. So that's sort of phase one, right? And now the question is kind of where do you go from here? And I'm just super excited about our next couple of years. I think we've got a huge opportunity ahead of us.
Where do you think Lyft is a year from now?
A year from now. Well, I tell you what, we are going to compete like heck on service. So from a rider and driver perspective, what I hope is that when you ask people, why did you choose Lyft? They say, because they just provide great service and better service than the other guys. And I think if we can do that over and over again, great things will happen.
What did you say in the article called plot a can of whoop ass on the competition?
Well,
that's the cool thing about it on a streaming network. You can pretty much say whatever you want.
Awesome. So I'll say it right here. Yeah. No, we did open up a can of whoop ass, but it wasn't actually on our competition. It was on a feature that people hate with a fiery passion, and that's surge pricing. Yeah, exactly. So this is an area where I think the innovation that we're bringing to the table really matters. So nobody likes prices that bounce around. It's super obnoxious. And part of it just comes with the territory. The concert gets out. There are only 100 cars and there are 1,000 people. So there you're going to get some surge pricing. But for a daily use like commute, this new product that we launched called Price Lock allows you to say, you know what, every day I'm going to go to work between 8 and 9, and I'm never going to pay more than $15. And you literally lock it in for a month, and it's been a great, great launch. It really has taken something that's annoyed people and taken it off the table.
Surge pricing, to your point, look, it pisses a lot of people off.
Yeah.
I mean, do you see it eventually going away?
I don't think it'll ever go away entirely, because remember what happens when prices surge. Basically what's going on behind the scenes is we're paying drivers more to drive right then. Maybe it just started raining. As I say, maybe a concert, an event just got out. So a lot of it is just that, and that you probably won't get away from. But what we can get away from are the more predictable times. Like we know what's going to happen with commute every day. And the more people who sign up for Price Lock, the more signal we get about where there's going to be demand and when. So that really allows us to sort of even it out and take it off the table.
Moments before you came on, David, I talked to AT&T CEO John Stankey, and
Yep.
he was talking about how his customers, his employees are still dealing with high levels of inflation. I'm like, you know what? That could be a tie-in with Lyft. You're seeing more drivers on the platform. Do you think that is because of macro concerns, where people are looking for that extra side hustle to offset budget pressures?
I look at it actually in an even bigger picture way. I think the gig economy is so here to stay. And I think it's hard for people, particularly folks like me. I'm an old guy. I was born in the 1960s, grew up in the 70s and 80s. So I think of a career in a certain way. Today's workforce is so much more about, I have work, I've got maybe another side hustle, I've got personal obligations, I've got free time. And so while I think, yes, there is a little of that for sure. I mean, when the economy stumbles, in fact, just on the second, for another second, there are macroeconomists who think that the gig economy is actually an incredibly important, almost sort of pressure relief valve. It allows people to sort of cycle in and out of the sort of, let's say you lose your job and you can sort of cycle into gig, and then you can kind of go back into a full-time if that's what you want. Anyway, having said all that, our driver supply is super healthy, but I don't really think it's because of budget pressures in general. I think it's because we've done a good job creating a platform that people like to earn on.
I love that you study travel from airports. And the other undercurrent here at this conference is that things have seemed to slow down a little bit in the economy. What are you seeing with trips leaving from airports? Because we have heard from the travel companies that things have slowed down a little bit.
So it's so interesting you bring that up. It's one of the use cases we look at very carefully, and we actually had seen some of that earlier in the summer. In fact, we mentioned that on our last earnings call. We just got data today, and this is data we look at every day, I just happened to get it, that says that our airport rides have now completely gotten back to 2019 levels. So we'd seen a little bit of that. There was a little bit of bump, but right now it's actually looking stronger than ever.
From what I could tell, you're delivering on a lot of things that you laid out a year ago. The top line has improved, you had the cost cuts, the profits are improving.
Yep.
Why is the stock still down 7% in the past year?
I mean, look, the short answer is I don't know. I'm not a stock picker. I'll tell you what I do know, though, and that is, well, first of all, we are building for the long term. We absolutely are. And that's why, again, our service levels are better than ever, our pricing's better than ever, and we've just got profitable and we are throwing off cash. So from our perspective, all that's good. So then the question becomes, well, why all this sort of noise in the stock market? I think there's sort of two things. I think part of it is just sort of macro concerns about the consumer. As I said, we saw a little of that, but we're not having, in fact, we've gotten stronger even since the last quarter, and even our shares ticked up versus our big competitors. So I think that was just a little bit overblown, and people see that. I think also there's a lot of interest in the world and what happens in a world of autonomous vehicles, and whether that's going to be good for us or bad for us. I think it's going to be great for us. I think it's going to bring new supply and, frankly, bring an experience onto the platform that a lot of people will find pretty cool and interesting.
People are going to want to rent out their cars or does Tesla have the right model on robo-taxis?
I mean, I don't know. We'll have to see what they say. I think, look, if that becomes an interesting model, that's something we're going to be super excited about, right? Remember, we have 1.4 million people who drive on the platform every year. Every single one of those we have to onboard, we have to pay, we have to offboard when they don't want to anymore and all that. So we know how to do that at scale. So if people want to put their AVs on our platform, that's great. That's what we're going to make easy. But anyway, I think that's a little bit of a, uncertainty in some people's minds. But the truth of the matter is, when I look at 5 years, rideshare is going to be so much bigger even than it is today. Kids today, it's not about getting your first driver's license anymore. Old people today, it's not about please take the car. It's the keys. It's I can still do what I want to do. So I'm very, very bullish both on our position but also on the overall industry, even if they're bouncing us up around.
Lyft CEO David Risher, good to see you again. I appreciate it.
Great to see you. Thank you, Brian. Yeah.
Julie, Josh, back to you. I can't believe this guy was born in the 60s. I mean, can you believe this guy is on fire? Looks great.
Thank you, Sazi.
God.
All right, let's get to some calls of the day now, sponsored by Tasty Trade. Deutsche Bank initiating coverage on Tesla with a buy rating. The note highlighting that Tesla is not, quote, an automaker, but rather a technology platform. Its stock's popping about 4%. So we just spoke to Gil Luria from D.A. Davidson. He says it is a car company, Julie Hyman. Deutsche Bank says, no, hold on. It isn't just a car company. It's how you value the stock. He's basically telling his clients that has to take that into account. Analysts saying at the core, we do not see Tesla as an automaker, but rather a technology platform attempting to reshape multiple industries deserving of a unique type of evaluation framework. He does initiate with a buy, his price target $295.
As they say, that's what makes a market, right? I love that these two notes came out on the same day. It's Edison Yu over at Deutsche Bank, who is initiating coverage, who is the one who is taking over coverage of the autos after the departure of Emmanuel Rosner. So interesting here. The note, by the way, today is on Tesla, but he also initiated coverage of the broader universe of automakers. And looking at that universe, he talks about liking General Motors in the near term over Ford because of the buyback and belief it can beat numbers, he said. Longer term, Ford, he says, seems more interesting based on its pivot towards its skunk work efforts. But he says, forget about both of those. We like Tesla the best.
And coming up, we got the robo-taxi event October 10th. On that, Deutsche Bank saying the analyst, his bias is positive, but will be tactically cautious coming out of the event. Could be sell the news reaction.
We'll see. Even though they are showing something that day, we have no idea when it will go to market, what it will mean financially for the company.
All will be revealed, maybe, or maybe not.
Something will be revealed, I guess. All right, let's talk about another coverage initiation. This one from B. Riley, initiating coverage on some beauty stocks. Anna Glaskin over there initiating coverage, buys on e.l.f. Beauty and The Honest Company, a sell on Ulta. And it is that sell that's really we've been watching today. The stock has had sort of a rocky year, Ulta, that is. Right now, it's down about 2% here. The price target on it is $300 per share. And they're looking at that the company has been sort of dominant in its category, but they say basically there is some go-forward earnings risk that is in part because of competition and in part because of further category deceleration.
Target is 300 per Bloomberg. That actually matches the street low. So to your point, talking about earnings risk given the competition, deceleration in the category growth, thinks comp sales will decline through the year end, tells her clients maybe extend into next year too. We see earnings risk as overshadowing the appeal of the relatively low valuation.
Now the price target on e.l.f. by contrast is $175 here. They call it, she calls it a high growth high quality growth story, excuse me. A couple of reasons here. Price point's attractive. Elf is at a lower price point and is particularly popular with younger consumers. So those are a couple of the reasons that she likes Elf.
Yeah.
Yes.
High valuation, she says, versus peers, but toward the low end of recent ranges. There you go. All right, now let's head back out to the Goldman Sachs 2024 Communacopia and Technology Conference in San Francisco. Yahoo Finance's very own executive editor, Brian Saws. He's sitting down with another executive. Take it away, Brian.
Yeah, Josh, it's been some day of coverage here. We're just talking about ride sharing with Lyft CEO David Risher. Now we're going to do a complete U-turn, literally, and talk some toys. Hasbro CEO Chris Cox. Chris, good to see you.
Brian, thanks for having me back.
So last year we had to talk about the conference. We had the same conversation a little bit. You were in turnaround mode. You know, you were launching a lot of key initiatives. So my question to you is, the platform has changed. Your company's so different. Are you still just a toy company?
Well, I think we're a toy company in the most general sense that, we're in the industry of play and we make physical things as well as digital things. But I'd like to think that we're helping to redefine what a toy company can be. To me, a toy company of the future is aged up, it's digital, and it's heavily partner-based. And I think that's been key to each of our turnaround nodes.
Kidults, right? Is that the term you've coined?
We didn't coin it. We use it now and then, but speaking for all kidults, me being one, I'd prefer just to call them fans.
Is it fair to say that older, maybe it is kid adults, people over the age of 13 are powering Hasbro's business?
Oh yeah, 60% of our sales are to consumers 13 plus. I think no other toy company in the industry can claim that.
Why do you think that age demographic is coming back to toys?
Well, I think it's a couple things. Three things really animate our strategy. I think the first thing is everyone plays. Play used to be something when we were kids where it largely stopped around the age of 12.
I'm still a kid.
Yeah, totally. Kidult. Now I think with the rise of digital, which is the second theme, it really powers a lifelong relationship with play. And so that's big and important to us as well. And then last but not least, partnerships. One company can't do it all itself. You have to work with multiple partners, and we have some of the best in the business. We work with Disney, we work with Takara Tomy in Japan, we work with Scopely, and they help us really propagate our brands and drive play.
Are the people in this room, a lot of investors, analysts, are they giving you, when you talk to them, are they giving you credit for your pivot into gaming? There's been a lot of deal activity in the gaming industry. A lot of these companies have sold at higher multiples, but based on my work, I don't think that's priced into your stock.
Well, that's nice of you to say, and I hope all investors here. Yeah, I think it is partially. Certainly, we have a higher multiple than most other toy companies. I think there's upside. I think it's a growing TAM. I think we have a decade head start versus anyone else in the toy industry. And I think it's a source of upside for us.
So you've been making bank off of Monopoly Go. That was very clear in the most recent quarter. What's next in gaming for you?
Oh, well, we have all the games that we're developing ourselves. We have about 8 or 10 that are in development.
Wow, mobile games?
They're PC and console is where we're focused. We have over 100 games in the pipeline on mobile through partnerships. And then we have several interesting JVs and partnerships that we're also talking about as well.
Why the partnership model? And is that more profitable than if you were to make the games yourself?
Well, I think it's all about having multiple business models to defray risk. So, I think it's important for us to be a games publisher. I think we have to have a relationship with our consumers and we have to understand what they want. But we're not going to be able to publish on every platform. We've chosen PC and console because that really works for our brands. Mobile, super high growth, probably the biggest aspect of the industry, but it's also super capital intensive. And you have to be an expert marketer and publisher in there. It's not for the faint of heart. So we have some of the best partners in the business, like Scopely, which is doing Monopoly Go, which has done over $3 billion of business since it launched. Biggest mobile game launch in history.
I talked to the CEO yesterday of your largest competitor. I'm sure you know who they are. He was unwilling to say that the fourth quarter of the holiday season would be up. What's your view on the holiday season, given everything we're seeing in the macroeconomy?
I think right now the consumer's holding up pretty well, and I think the toy industry is returning to its traditional role as a resilient category that retailers can rely on. Certainly, we're seeing our toy business being up in Q4.
One number from your most recent quarter really left an impression with me. Inventory, down 51% year over year. Two parts. How is that happening? And will you have enough inventory for the holiday season? I have never seen a decline like that before in the toy industry.
Well, a little bit of that is we weren't as responsible about it as we should have been a couple years ago. And so I think we've made a lot of moves to make sure that doesn't happen ever again.
So too much inventory.
Yeah, we had too much inventory coming in 2022 out of the pandemic. And so we've right-sized that. We've also done a ton of work to put in the right processes, right procedures, right talent to manage our inventory. So not only is our inventory down, the cost of our products are way down as well. Supply chain is going from what I would say was a weakness for us in 2021 and 2022 to a real source of differentiation and strength for Hasbro.
So if I want a new Nerf gun this holiday season, I'll be able to find it.
Yes, but I would say buy early.
Okay, fair enough. Hasbro CEO Chris Cox, good to see you.
Brian, thanks so much.
All right, I appreciate it. Always great to get some time with you. We'll be right back on Yahoo Finance.
Tech stocks seeing sharp declines to start September. The Nasdaq Composite shedding about 5% so far this month, and some of the worst performers are Nvidia and Apple. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. Dan Flax, Neuberger Berman Senior Research Analyst, is joining us now. Dan, it's good to see you. Those two names, among others, are still among your top picks. And, you know, obviously we've had some volatility come into the tech trade. There are different stories with the two of them. Let's start with Apple, since we just had the event yesterday. We had the EU tax ruling this morning. Why are you sticking with that one?
Good to see you. I think what's going on with Apple is that they're demonstrating that they can continue to innovate. We see with iPhone 16 the camera control, Apple Intelligence, the journey around that is beginning. That'll play out over many months. But the user experience is continuing to change. I think the developer community remains healthy. And what we'll see over the coming months is that growth should be a little bit better. You're seeing the installed base continue to increase. China, while a concern, Apple has continued to navigate that pretty well. And so services remains durable, and the wearables opportunity, in my view, remains early. And so I expect better growth over the next year, which will contribute to stock price outperformance, in my view, from current levels.
Let me also get your take on NVIDIA, Dan. You know, one concern that I want to get your take on this is this idea that big tech is going to start coming under some pressure from their investors to just kind of slow down this rush of AI spending. What do you make of that concern, Dan? What could it mean for NVIDIA?
Brian, excuse me, Josh, we're sitting at a very interesting juncture here because you have the cloud vendors, Amazon and Microsoft, Google, investing aggressively because they see revenue growth opportunities in their core businesses and new opportunities around generative AI. And so they're spending aggressively. There is some concern around the capacity, but in my view, they're going to be able to absorb that as we think through the coming quarters and over the next year or two. As far as NVIDIA is concerned, there's a little bit of a delay in Blackwell, their new platform, but demand for Hopper remains healthy. And I think the key for NVIDIA is to continue to execute on its product cycles. What's happening with artificial intelligence, there's really a whole host of new use cases. If you think about the healthcare world, drug discovery, studies around climate change. In manufacturing, you have digital twins. And so there are a lot of new opportunities for both the cloud companies as well as traditional enterprises to transform themselves over the next couple of years. And NVIDIA really sits at the heart of that opportunity. So we continue to like that name, appreciating, of course, that there is some near-term volatility.
Dan, how quickly and at what magnitude are these companies going to have to start to really show more profit directly tied to some of this AI technology?
I think for the traditional cloud vendors, they're seeing revenue like Microsoft Azure in the billions of dollars today. I think that will continue. Now, clearly, they're investing to drive that growth. But if the market sees and the companies are demonstrating that there are large revenue pools to be captured in both the near and perhaps, as importantly, the medium and long term, I think the market will be okay with that. The key for these companies is to drive growth in these newer areas while at the same time demonstrating that in the core, the existing businesses, things are healthy. So if you think about the cloud businesses, you're continuing to see a shift towards the cloud. And when we speak to enterprise customers, many of them are relatively early in their journey. Part of what they're getting is that they're getting access, like with generative AI, to the newest tools and technologies. And so that's why they're going to the cloud, in addition to the ability to turn on the capacity, like flipping a light switch. It's very quick. And that's a contrast with a lot of the traditional IT infrastructure. And so it's a journey, and our focus is on the companies like an NVIDIA that can innovate and really empower their customers as we think about the customer's ability to capitalize on all this as we move into next year and beyond.
Dan, also want to get your take on Oracle. Larry Ellison's company reports investors clearly like what they see, Dan. The stock up about 12% right now. What did you make of that print, Dan? And also just your take on the broader business software landscape.
The results were solid. Oracle's demonstrating that they're really able to invest and drive growth in the Oracle Cloud. And when we speak to their customers, they like what Oracle is doing as they extend their ability to deliver value for their workloads in the different clouds. We saw the Amazon Web Services announcement last night. So Oracle customers are liking the fact that you can continue to run workloads on-premise, but also move into the cloud. I think the growth for Oracle Cloud is likely to remain robust over the next few years. It's certainly lumpy quarter to quarter, but the company's investing, customers are seeing results from migrating to the cloud, and I think it sets the company up well as I look out into next year. So we continue to like that name as well.
All right, you and a lot of investors, Dan. Thank you so much as always coming on the show. Appreciate it.
Thank you.
Well, we're wrapping up today's market domination. Do not go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. Let's see where the major averages ended the session here, remaining mixed on the day, but sort of stalling out a little bit from some of the gains that we saw yesterday. We have CPI tomorrow morning, although that has sort of lost some importance in investors' minds. And then, of course, folks looking further afield to the Fed decision a week from tomorrow. Right now, we've got the Dow down 92 points, finishing the day lower by about 0.25%. The S&P to the upside, though, almost 0.5%. And the Nasdaq leading gains here, up about 0.8%. So that was the overall action. If you look at the groups that were on the move today, yes, you had tech here up 1.5%, but real estate also strong, up by nearly 2%. Consumer discretionary, so sort of mixed here between an interest rate sensitive but also more cyclical groups, sort of an interesting play there. On the downside, we had energy stocks falling along with oil prices, and the financials, which we talked about earlier, but just to get sort of a closing check on some of those stocks as well. What we saw from the banks was some commentary that caused them to fall. There is the bank board there. JPMorgan down 5% when all was said and done after President Daniel Pinto said at a conference that Wall Street's estimates for net interest income and expenses might be a little too sunny. Goldman Sachs said its trading revenues were falling by 10%, so those shares down. But on the flip side, as we talked about, the Nasdaq really standing out today. A lot of strength in large cap tech, in particular, Amazon up 2% and Microsoft up 2%. Tesla up 4.5%. Josh?
All right, Julie. It was a choppy day on Wall Street, as you pointed out. Investors wait on the Fed decision now next week, and our next guest says volatility is back and clients are using it to their advantage. And joining us now is Joe Mazzola, Schwab, Head of Trading and Derivatives Strategist. Joe, always good to see you.
Josh, thanks for having me.
So you say, Joe, markets are indicating that now may be a time to proceed with caution. What do you mean by that?
Yeah, we saw a little bit of a pickup in volatility last week. You know, the VIX trading above 20, pulled back a bit, but you know, some of the things that I kind of keep an eye on would be things like skew, right? So, you know, puts over calls where we're starting to see some rotation. I think you're starting to see that on the institutional side where you're starting to see some of that downside buying. And it's actually kind of made its way over into the retail side, which I'm a little bit more familiar with. You know, being at Charles Schwab, we're starting to see that as well.
And so when you look at support levels, I know that's something you're looking at. What levels are you looking at, and how is that sort of backed up by what you're seeing from retail traders?
Yes, so you know, we've been bouncing around that kind of 5,400 level. I think if we get a pullback from there, I'd be looking at around that 50% Fibonacci retracement, kind of put us down around the 53. I think 5280 is that level that I marked down. So just something that I think from a perspective of a little bit more psychology in terms of the market, because I think you have to remember this, a lot of it's built into the sentiment. And as we start breaking down below those levels, you might start seeing a little bit less of the dip buyer stepping back in. We got a great amount of dip buying after the August
I noticed that, right?
sell-off.
I thought that was interesting.
Yeah, and it carried through for a couple weeks, but then kind of by the end of the month, a little bit of profit taking, some of the dissipated. You know, if you look at some of the tech names, you got moves in NVIDIA from $90 all the way up to 120. People took some profits off the table. It's okay.
And when you mentioned the dip buying, Joe, you have line of sight to what they were buying?
Yeah, absolutely. So the top three stocks that we saw purchased in the course of May through our stacks report would have been NVIDIA being number one, Amazon number two, and then the third one, which I thought was really interesting, kind of given the pullback that I had, was Intel. So, you know, old tech.
They moved into Intel.
They moved into Intel. I mean, look, it pulled down 30%, right?
Yeah.
You know, after earnings. And you know, I don't think it was the forecast was very strong, but you know, I think sometimes you just see some dip buying, you see some people looking for some opportunities, and that's probably what we saw.
I don't know if they got the opportunity though. At least not yet. We'll see how that works
we'll see
out.
how that
but on a
out.
similar front, people were buying energy stocks. And energy's had a little bit of a tough time.
That one was hard for me to kind of wrap my head around as well too. You know, when we look at the two sectors that were purchased, discretionary, so consumer discretionary, I think a lot of that had to do with the Amazon purchasing that we saw throughout the course of the month, but then energy as well. And once again, that might just be clients looking for, you know, some opportunities just because of the pullback that we've seen in crude. Not to say that won't continue, but at least for where we're at right now, that's what we're seeing.
Do you have any line of sight, Joe, besides stocks, any moves in commodities that piqued your interest?
Yeah, maybe not commodities, but fixed income, I think was important because we did see a big rotation into that. And that was, like I talked about, at the end of the month, we started to see some of that buying momentum into equities fade a bit, and that really rotated into fixed income. I don't know whether or not people are trying to kind of front run the Fed in next week's meeting. I think that's a possibility. Maybe they're trying to buy it before yields go down further. That to me was probably, that would be my guess. But in terms of other commodities, haven't seen a whole lot of buying that's kind of precluded any big moves there.
One thing we were talking about earlier with another guest was cross-asset volatility, which has been ticking up. I mean, the VIX spiked, right, and then came back down. That spike happened in early August, but now it's creeping up again. Dollar volatility creeping up, fixed income volatility creeping up. What do you make of that move?
Well, I mean, just look what's happened in bonds. I mean, you've seen a real big move in the bond market. You've seen the yields kind of pull back pretty dramatically. And when you see that increase in fixed income volatility, a lot of times it spills over into the equity markets. Not always, but that's kind of been the case going all the way back to March of 23, right? When you had the regional bank crisis. And we saw a lot of that volatility from the fixed income market. That's been one of the indicators I've been following for a while is the MOVE index and how that's kind of predicated a move within the VIX. We're starting to see that again right now.
Interesting.
What about, Joe, for those who aren't familiar, the Schwab Trading Activity Index? Explain for viewers what that is and what it's telling you right now.
Yeah, so what's really cool about that is it really gives us insight into the behaviors of our clients. So we're not asking them how they feel. We actually do have a study that we do with that as well. But we look at 32 million accounts. And we have the ability to kind of take a cross section of that and say, okay, what was your activity throughout the course of the month? If we're starting to see more kind of higher beta names being purchased, that's what pushes it up. So not only does it look at buying activity, but it kind of looks at what they're buying. I told you that the three stocks that we saw the greatest amount of purchases in, but we actually saw it come down a little bit in terms of the overall index itself. And the reason that is because there was a rotation out of some of those higher beta names into fixed income. So fixed income, as long as they buy that can still move it up, but it won't move it up as quickly because of the lower beta that it has.
Do you tend to see, are there levels that you watch that then can presage other moves either in the market or in future retail activity?
Yeah, so the range that we've really seen really since the genesis, the existence of this goes all the way back to the TD Ameritrade days when they used something very similar. The range is about 35 to 75 is, I would say, a typical range. We're kind of smack dab in the middle, around 53 right now. Where we saw the highest ticks would have been around 2021, and that would have pushed it in that 70 level. Gets to that level, I consider it probably a little bit of FOMO and something to kind of keep an eye on. Now, I will say this, though, when you kind of recalibrate it, and if you look at that as an outlier, I would probably be looking somewhere in that 60 range right now is kind of the new range.
Gotcha. All right, we'll be watching it. Thanks for
you.
coming in, Joe.
Thanks, Josh.
Appreciate it. Well, stick around. We've got more market domination overtime coming up.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Welcome to the Goldman Sachs 2024 Communicopia and Technology Conference. I'm Madison Mills alongside our executive editor, Brian Sazzi, and we are joined by Michael Ng. He is a senior equity research analyst over at Goldman. Michael, thanks so much for making time with us.
Thank you for having me.
So I know you cover Apple, so we got to start there. The big event yesterday, the unveiling of the iPhone 16 powered by AI. Seems like it was a little bit of a disappointment. Do you think it was disappointing?
I think it was an event that delivered in line with investor expectations. We looked at Apple's stock performance over the last 5 years on the day of iPhone announcements, and historically, the stock has underperformed the S&P 500 by about 70 basis points. And on Monday, it underperformed just over 100 basis points. So for the most part, we think that was in line with historical events. And when you look at the individual product announcements, it came in mostly as expected. Apple unveiled its iPhone 16. The 4 models came in priced similarly to a year ago. And they reaffirmed that Apple Intelligence would be coming out in beta next month with more features rolled out over the subsequent years. So no huge surprises. I think it was straight down the fairway.
So coming in at expectations, not always enough for Wall Street these days, especially amid the AI rally. Given that, should investors still be buying Apple?
We're constructive on Apple. We're buy rated, and we think that there's an underappreciated uplift in their normalized earnings power as more people start to upgrade their iPhones. Specifically, we think that investors have historically thought about Apple iPhones at a normalized sell-through rate at about 225 to 230 million units. And we think that AI and some of the new product features that are going to get rolled out over the next few years is going to bring that normalized run rate closer to 250 to 260 million. And I think there's a tremendous amount of debate about whether or not AI is going to actually be that demand driver. And I certainly believe that it is. But one thing that I would also highlight is that we're going to see several different form factor changes over the next several years. The iPhone 16 Pro and Pro Max have larger screen sizes than the iPhone 15. And the rumors for the next couple of years are that the iPhone 17 will be a thinner device. The iPhone 18 has the potential to be a foldable. So in addition to AI, there are some form factor changes that I think will drive an upgrade cycle.
Another company that you follow, I would say, is going through some form factor changes. I don't know, this is a great transition. What do you want me to do? Warner Brothers, Warner Media. Big impairment charge. They're presenting here at the conference. CEO David Zaslav will be here. What's the end game for a company like that? And will they grow again?
Yeah. I think the way to think about Warner Brothers Discovery is that they're managing their video business holistically. The linear TV network business is certainly having challenges. Cord cutting is unrelenting, and pay TV subscriber declines will continue to occur. That being said, it's an incredibly cash-generative business, and it helps to fund growth investments elsewhere in the Warner Brothers portfolio. They are getting some momentum with their direct-to-consumer product with Max. In addition, I think that there's a crown jewel in the Warner Brothers film and television studio. There's a lot of marquee IP that sits within the film library, and it has a long history of producing several of the most successful television series that we've seen to date.
One company that you also cover that's not here, that's Disney. Now, we're all still waiting on who that successor to Bob Iger will be. When you talk to investors, do they really care? How important is that CEO position at Disney? And then, because it is so important, how would any new CEO that comes in here, how would they set the path for future growth?
When I talk to investors, succession planning is incredibly important because it dictates the strategy of the company. And I think over the last few years, prior to Mr. Iger coming back into his current role, we've seen a few missteps, perhaps on the film and TV studio side in particular, where there has been some market share loss. As we think about the go forward, I'm not going to speculate on who necessarily is going to replace Mr. Iger, but I think there's a tremendous amount of focus on what that succession planning looks like. One observation that I'll make is that they have an incredibly deep bench of talented executives across each of their business lines. theme parks, film and TV studios, and obviously at ESPN.
Do you still rate, given the pressures we're seeing at Warner, do you still rate Disney a buy? And then what's the case or thesis behind them?
Yeah. I think that there's going to be a short list of media companies that can have large-scaled streaming video businesses. I think Disney probably sits there among a few other companies, namely Netflix and Amazon Prime. And for streaming video, it's really about operating leverage, scale, and if you don't have that scale, you can't really get the leverage out of the content investments that you have to make, which are semi-fixed, somewhat fixed, right? So, I think Disney's certainly at the top of the list in terms of direct-to-consumer products that could be successful. And one other thing that I think puts Disney in a very good position over the long term is its marquee sports rights portfolio, many of which are locked up through the end of the decade. So I think that sports continues to be one of the genres that continue to perform well in the volatile pay TV environment that we're currently seeing, and I think Disney's in a really good position to benefit from that.
Michael Ng, thank you so much for making time with us. Really appreciate it. Stick with us for more markets action ahead right here. This is Yahoo Finance.
This is Yahoo Finance, and I'm Julie Hyman, taking a look now at GameStop shares. The company's second quarter results hitting the wire. The shares up a little bit, just about 1/3 of 1%. The company's net sales did fall 31% year over year to $798 million, but it did also report a gain, a net income, $14.8 million for its second quarter. That compares to a net loss of $2.8 million for the prior year's second quarter. Now, I could tell you that the company beat or missed estimates, but there are so few analysts that even cover the company this way. I mean, we're showing the estimates. I don't know how much weight to even give them because there aren't that many analysts who covered the stock at this point. So it's tough to even, apply the same paradigm that we do to most other companies.
Heading into the report, stock was up about 40% this year. Of course, remember earlier this year we covered that. Roaring Kitty.
Sure.
Keith Gill came in, gave the stock a lift. There are very few analysts though covering this name. One is though Michael Pachter over at Wedbush. We both know Mr. Pachter very well. Not a fan, Julie. Argues the company faces, here's words, a near insurmountable barrier to its planned return to growth. That is what Pachter told his clients, including, he says, the ongoing shift of game sales from physical to digital, among other reasons.
Yeah, remember Ryan Cohen is now the CEO of the company. He has been. He owns just under 9% of the shares in GameStop and is joined by a lot of those meme stock folks. He does not tend to talk on the conference calls. They don't, they don't tend to take questions, I should say. Traditionally, you have a very short conference call, if anything. And there is not a Q&A period. So presumably it'll be the same kind of situation today. So it's difficult to get more color.
Yeah, well, he's welcome on this show anytime. Anytime.
Ryan Cohen?
That's a formal invitation.
Come on down.
It is. Time now for What to Watch. Starting off on politics, we'll be eyeing the fallout from the first debate between Vice President Kamala Harris and former President Donald Trump, which takes place in Philadelphia tonight. The debate will air at 9 p.m. Eastern on ABC News, and for those with DirecTV, you will still be able to watch the debate despite the Disney blackout. Disney saying in a statement a 3-hour feed of ABC News coverage to all impacted DirecTV customers at no cost.
And then ahead of the opening bell tomorrow, the August CPI report. Economists forecast both core CPI and total CPI will edge up 0.2%. The new print will give us more insight into the health of the consumer. And it's also the last major piece of economic data before the next FOMC interest rate decision next week.
And finally, tune into Yahoo Finance tomorrow for more coverage of the 2024 Goldman Sachs Communacopia and Technology Conference in San Francisco. We'll have interviews with AT&T CEO John Stankey in the 10 o'clock hour and Robinhood CEO Vlad Tenev in the 11 o'clock hour. Final quick check here of the market sponsored by Tasty Trade. Markets closed the day mixed. Dow closed in the red. Really two sectors that we talked about, Julie, is tech, which actually you can see Nasdaq outperforming with Oracle. Banks, though, a drag.
Yes, banks a drag indeed after some commentary around the Barclays Financial Services Conference. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered with the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Markets closing the day mixed, with the S&P 500 squeaking out a gain for the second day in a row. Investors, we know, waiting on the Fed decision next week, and also tonight's presidential debate. But one big mover today was oil. Crude closing at its lowest level since December 2021, and the ripple effect of lower oil prices being felt at the pump. Gasoline prices falling, with at least 10 states seeing prices under $3 a gallon. And another big loser on Wall Street, bank stocks. We're taking a deeper dive after a pair of warnings from Goldman Sachs and JPMorgan Chase. Oil resumed its downward trend on Tuesday, tanking more than 3% after oil alliance OPEC lowered its demand growth forecast in 2024 and 2025. And joining us now with more is Yahoo Finance's Inez Ferre. Inez.
Yeah, Josh, and the market has really been contending with a couple of bearish factors when it comes to oil. First of all, you've got weakness in China, economic headwinds there. You have China switching to more natural gas, seen as cleaner and also less expensive than oil. Another factor also that is increasing spare capacity is OPEC Plus. Last week, OPEC Plus was forced to postpone the unwinding of its voluntary production cuts, meaning that these oil alliance countries are sitting on the sidelines with additional capacity at hand. Then there's another technical factor that has also been accelerating some of the oil prices that we've seen to the downside, and that has to do with the futures curve. It's been mostly in what's called backwardation. That's a bullish structure. That's where a commodity is less expensive if the buyer receives it in the future rather than now. Now, what traders are seeing now is that Brent futures curve is essentially flat, meaning that there's, again, a lot of spare production capacity around the world. OPEC also today slightly lowering its demand growth forecast for this year and 2025, though OPEC is the most bullish really when it comes to the oil growth forecast compared to other agencies. Oil has been searching for a floor, so you have seen these crude prices going lower and lower. Today, Brent crude down more than 3%. That is at its lowest level since, as you just mentioned, December of 2021. Also, WTI crude prices that are low. Year to date, you are looking at WTI that's down more than 5%, Brent crude down more than 8%. And check out the gasoline futures. These are also at 3-year lows right here. So if you are not seeing in your state gasoline at below $3 per gallon, it is expected to be coming to a gas station near you by the end of the year, according to one analyst that we spoke to. Josh.
Inez, let me ask, when you're talking to traders, strategists, and you're asking where they think oil is headed from here, what are some targets you're hearing, Inez?
Yeah, look, well, we have seen that Goldman has reduced its target, its range for Brent crude around the $70 to $85 per barrel. You also have JPMorgan that has reduced its target to 80 for the end of this. For the fourth quarter of this year. You have firms that have been lowering their targets. For next year, though, you're seeing Wall Street that is saying that Brent crude is going to be in the mid-70s, as Goldman Sachs had predicted. So you are seeing that next year you are going to be seeing oil go lower. You had the EIA that's saying that despite this move that we've seen to the downside, you still have OPEC Plus, which is really maintaining that supply equilibrium. So you are going to see prices going higher from here. Not as low as what we're seeing here with $69 per barrel for Brent. But look, oil tends to overshoot and also undershoot as well. So whenever you see these exacerbated moves, you are going to see a bit of a rally after this. But where this equilibrium is right now, it still remains to be seen. We're going into the winter months, so it's less demand that's expected in these months as far as summer driving fuel, et cetera.
All right, Inez, thank you. Appreciate it.
Thank you.
With fall approaching, summer driving season is coming to an end and temperatures dipping in much of the country. Gas prices dipping as well, but will they stay lower? Joining us now is Patrick DeHaan, Gas Buddy, Head of Petroleum Analysis. Patrick, always good to see you. Let's just start big picture, Patrick. Where are gas prices right now nationally, and where do you see them headed in kind of, let's call it near intermediate term, Patrick?
Well, Josh, for at least now, the national average is down for 6 straight weeks already. So nice ending to the summer. Now that we're getting into cooler weather, that downward streak is continuing. We expect that the national average will eventually fall below that $3 a gallon mark for the first time since 2021. Now, keep in mind, a lot of what we're seeing is seasonal. That is, gas prices would likely go down this time of year, regardless of if oil was stable or even rising. Americans just don't drive as much in fall. Some loss of allure of putting the boat in the lake when the air temperatures start dropping to the 50s and 60s. So less demand. We're also switching back to cheaper winter gasoline. That's something that can happen Monday of next week. And then the double dose of oil prices that have fallen to $65 a barrel, certainly going to help accelerate this train, this locomotive that's moving. We expect the national average, as I mentioned, is likely going to fall below $3 a gallon here in the next couple of weeks.
What would be some upside risks, though, to consider there, Patrick?
Oh, certainly one sitting in the Gulf of Mexico right now. Certainly Tropical Storm Florence, actually Francine. There's a lot of different names to get in hurricane season, but Francine is something that we continue to monitor. A couple of refineries scaling back in preparation. Hurricane season still likely to be very busy. There's a couple other areas of interest. So while Francine, being a relatively low storm, may not impact prices, that hurricane season is something to keep an eye on, at least for the next few weeks. And of course, there's always the possibility that the Middle East could see violence at a moment's notice. In addition, one wild card, we saw it overnight. Ukraine continues to go after Russia with drones. When those drones attack refineries, that can lead to a little bit of upside to oil and refined products.
You know, Patrick, we always talk about gas prices nationally. Let's break it down, though, a little bit more. Where are gas prices highest right now?
Well, Josh, you can see it a little bit in the map behind me. California, glowing yellow, that is the nation's highest gasoline price. Prices there still well over the $4 a gallon mark, although if you use an app like GasBuddy, you can find it under $4. The entire West Coast still, especially Northern California. In fact, we're talking about the national average having gone down 6 straight weeks. But if you're in Northern California, the Bay Area, even areas of Southern Oregon, there have been some refinery glitches that have pushed prices up there. Washington State, Oregon, of course, Hawaii, and Alaska also still amongst the pricier states.
All right, so highest in my native California, Patrick. I'm just curious, where are they lowest?
Well, again, the graphic behind me, you can just about head anywhere in the Gulf Coast and see some of those low prices. In fact, 12 states below $3 a gallon. I picked out a station the other day, rather incredibly, in Mississippi, $2.38 a gallon for a cash price, and that was a couple of days ago. So you're seeing a flood of those sub $3 a gallon prices predominantly throughout much of the South.
How important, Patrick, are prices at the pump in terms of just shaping and impacting how consumers feel, consumer sentiment?
I mean, it's huge. Whether you need gasoline or not, when you go by the gas station, it's kind of economic sentiment for how you feel, the barometer for how you feel about the broader economy. And these lower prices, these sub $3 prices, are sure to boost consumer sentiment here going into the fall. Biggest question is, will the Fed deliver on a rate cut that'll help Americans start feeling a little bit better about the cost of borrowing as well?
Patrick, always great to see you. Thanks for coming on the show.
Thanks, Josh.
Tech leads the S&P 500 and Nasdaq higher. Meanwhile, JPMorgan's warnings on net interest income forecasts weighing on the Dow. Here with the trading day takeaway is Yahoo Finance's Josh Schaefer. Josh.
Hey, Josh, yeah, I want to stick with what you just mentioned off the top there. Comments out of JPMorgan saying that they feel like net interest income expectations might be too optimistic right now. That follows Goldman Sachs yesterday saying a similar thing about what they're seeing in the third quarter on trends overall, Josh. And really why I want to take a look at that is the stock reactions we've seen in financials over the last day. So financials down 1% today, and we'll flip over to the actual bank stocks themselves. Pretty rough day for the big banks today. You see JP Morgan down over 5%, Goldman Sachs down more than 4%. And the reason I bring this up, and I think it's interesting from a macro perspective, remember, I always like to attack these things with you from sort of an S&P 500 standpoint, right? Well, what's been one of the best performing sectors over the last 2 months? Let's take a look here. One of the best performing sectors has been XLF, right? And even you look year to date, financials have done pretty well overall, and they've been a part of this recent rally. They're the second best performing sector year to date. That's been part of the rotation trade, right? We've been talking a lot about this rotation out of tech into the other 493. Well, a lot of that's based off earnings expectations, and people are expecting these companies to be able to support why people are flowing into them. So to me, it was interesting as we head into this earnings season after we've had this great rotation, how are these companies actually going to do? We don't know, right? And there's a chance that perhaps maybe this rotation rally hits a little bit of a bump if the companies just don't do as good as we initially thought.
And only a few weeks out there when they kick off earnings
We
season,
are about
right?
a month away from JPMorgan's earnings, almost exactly. So yeah, there'll be a lot of fodder to sort of chew on over that next month, which brings us, of course, to our next takeaway, which is earnings, Josh. So right now, it's been interesting to watch. So Q3 earnings estimates are being cut. We talked about this a little bit last week. Earnings are normally cut, right? So we're at a 2.8% cut for the first 2 months. This means analysts have been trimming their estimates as we go through the quarter. That's about average. The average over the last 20 years is 3%. The average going back 15 years is a little bit higher than that,
So
or
it's typical.
lower. It's typical.
Yeah.
And so what strategists were highlighting this morning, this was the team over at DataTrack, they said, well, this is okay because it's kind of normal. You can see it's not abnormal to have estimates cut, and then zoom out. Right now, 2025 still looks pretty good, right? And so the question here is, can the market really do this? And something that was interesting that one of your prior guests, I was just speaking with Joe Mazzulla over at Charles Schwab, he said, well, if you have this, right, this is very optimistic, and you also have 10 Fed rate cuts, which one do we get? Because it feels like this is very optimistic about sort of the state of the economy and the overall corporate sector. If this is true, why would the Fed cut 10 times over the next year? That's kind of a broad question that remains out there right now.
I'm also interested because you wrote a piece about this, how you look at earnings estimates and another sign of that broadening we've been talking about as well.
Yeah, so it's interesting. You look at this 11.3 here, right, that we saw for Q2. When we had seen the positive earnings results over the last couple quarters here, it was all Mag 7. So these numbers would have been negative if you take out the Mag 7. For the first time here, this 11.3, this was actually partially driven by that 493. First time in 6 quarters that the other 493 have posted positive year-over-year earnings growth. So now, again, as we were just discussing, the question is, does that continue and keep propping things up as tech starts to fall off a little bit? Or does it not, is kind of the looming question as we enter this earnings season. Again, a month away.
Stay tuned.
A final thing, Josh, for us, as it is debate day for the presidential election, I thought it was interesting to just...
Could be your first and last debate. We don't know.
We don't know, right?
Tune in, yeah.
We do not know. But one thing that has been true is this is sort of when the volatility starts to pick up. The debates start, and this was...
Starting now.
Starting now.
We're in it. Okay.
Here we go. October, so I guess we're not quite in October yet, but this is your big VIX spike that you normally see in election years. This is from Keith Lerner over at Truist. And then you sort of see it come back down in November, right? Normally, in most election cycles, we have a definitive candidate by the first week in November, so your volatility comes back down. But I guess my point here being, and the takeaway sort of being, it's okay if the markets get a little jittery right now. That's normal. That's how election years work. It's supposed to be a little bit volatile going into the first week in November.
And then important for traders, but let's say you're an investor and you're watching this, Josh. You have a longer term horizon. How should you think about these
Most
data?
strategists are going to come on this air and tell you not to mix your politics with the stock market, right? And that is because if you take a look at, we'll use the last 3 presidents here, we're looking at data, so this is from election day. This is not from when they took over and started implementing policy, but it's from when the market knew that that person was going to be president, what the S&P 500 did into the next election day. All pretty good numbers in my opinion. 13%, 14%, 17% average annualized return for the S&P 500. In other words, the stock market hasn't necessarily been driven by who is president when you go back in history. It's driven by things like, is the Fed going to come up with a soft landing? Is that going to happen? Is the AI narrative going to live up to the hype? Keith Lerner highlighting in this note, he still worries more about those concerns and whether those happen than who's going to be in the White House.
Yeah. Be cautious about mixing politics with your portfolio.
Separate things sometimes.
Yeah. All right, thank you, Joshua. Appreciate it. And coming up, big banks in focus today as JPMorgan fell. We're going to speak to an expert on the matter when asking for a trend returns. The Federal Reserve unveiling changes to its original plan on capital requirements for banks, scaling them back. Fed Vice Chair for Supervision Michael Barr saying the proposed changes would, quote, better balance the benefits and costs of capital in light of comments received. However, big banks we know came under pressure in today's trade as JPMorgan voices a cautious outlook for next year. And joining me now is David Conrad, Managing Director at KBW, a Stifel company. David, you are just the man to talk to today because your coverage universe, David, in focus, making a lot of headlines, different threads. I actually did want to start with JPMorgan. So JPMorgan's president, David, he's at a conference and he says, you know what, I think analysts might be just a bit too rosy here, I guess, in their projections of next year's net interest income, expenses. What did you make of those comments, David?
Yeah, well, we are actually below the street for 2025 in NII, but basically what's gone on here is, first of all, JPMorgan's one of the top financials globally and getting really stronger almost every day. But what happened this past year is their guidance kept being raised because they're asset sensitive. The forward curve didn't materialize and the Fed really didn't cut rates yet, obviously this year. So their estimates this year beat expectations. But now as we're looking, going forward, we're expecting 3 to 4 cuts perhaps in this fourth quarter and then cuts next year as well. So some of the asset sensitive names will feel some pressure as we go into next year on their NII.
And let me get your take on another name, Dan. So I know JPMorgan, I believe you're on the sidelines, but another name you cover also made news. Goldman, that's a name you like. Goldman's chief also making comments saying, listen, maybe trading revenue could fall 10% in Q3. Your reaction to those comments, David?
Yeah, there's a couple things there. That was a little bit disappointing. Obviously, trading's a little more of a volatile number, and they were coming off of a really difficult comp in the prior year. But there's a lot of volatility in August, and it's seasonally, also a slow volume period as well. And so, we think that's a little bit not necessarily a trend line, but a tough quarter there. The other thing they announced was a $400 million charge on contra revenue as they prepare to sell the GM credit card portfolio. Although that was a negative headline, we actually think that's good news for the stock.
Broader question, David. This morning, new proposed capital requirements. When you saw those numbers, was that basically in line with your expectations, David? Were you thinking it was going to be lower? What'd you make of it?
No, I think they were largely in line. I mean, it took away a negative scenario, but reducing the capital requirements by 50% was kind of in the market a little bit. And that's really basically where it came into. So, I think, Vice Chairman Barr said that, he expects capital to go up around 9% for the GSIBs. We're currently 11% in our model. And that feels about right because, the bank's calculation has historically been a little bit higher than the Fed's calculation. So largely in line. And then the other move there was the RWA inflation won't apply to the category 4 banks. So that's the banks between 100 and 250 million. That's really a non-event. The RWA inflation wasn't that high for them anyway. The big issue for them is the mark-to-market of the bonds, which still does stay in the capital. So kind of a non-event for that.
And does it mean, David, would you expect banks now accept that proposal, think this is as good as it's going to get, or would you expect them to fight?
Oh, there'll be a little bit of a fight, right? But I think this is broadly, what they were looking for. I mean, I think what happened is, the Fed typically gold plates the international standards, and then they took it a step further with this proposal. So what ended up happening is you had the U.S. banks holding a lot more capital than the global banks. And so I think this largely adjusts that.
David, a quick question here. Last one. I look through your coverage universe. I only see one sell, one lonely underperform, and that is PNC. How come?
Well, it's one of the more expensive names out there. It is a quality name. Their kind of outlook is for a very strong 2025 NII, a record number, but we think that's largely embedded in the numbers. And so it's trading roughly at a 2-turn premium to the group with relatively inline returns. So we just think as numbers come in, as its peers recover on capital, we think there'll just be a mean reversion of those P's closer to the peer levels.
David, appreciate you coming on the show, and thank you for those stock picks.
You bet. Thank you.
Coming up, I'm checking in on a few tickers that are moving after hours. Stay tuned. More asking for a trend right on the other side.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
We're looking at volatility in the dollar and bonds in our chart of the day. Both are on the rise. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, I've seen an uptick in chatter about cross-asset volatility as of late, and so we decided to take a look at this today. So this is a chart going back to the beginning of June, and looking at the volatility ticking up in the MOVE index. That's the blue line here. That's volatility in the bond market. And then the 3-month implied volatility in the dollar, specifically here the Bloomberg Dollar Index. So both of them ticking up here. There's been some talk that perhaps this is happening as we approach the election. Of course, the debate is tonight. And there's also some other factors, the beginning of the Federal Reserve's interest rate cutting cycle, some uncertainty around how large their first cut is going to be, and then what the pace looks like after that point in time. We're in between earnings season. So a lot of factors contributing to this uptick that we're seeing here. Now, as for what it then implies for volatility elsewhere, specifically in what's going on with stocks, pardon me. We, of course, look to the VIX for that, which measures stock market volatility. We had that spike in early August, and since then it has been sort of creeping back up again. We talked to a couple of investors and strategists earlier about what the volatility cross-asset means for stocks specifically. There seemed to be some consensus here that it means it's going up. Mark Newton is one of those folks we asked.
The volatility is, a source of major discomfort, I think, for everybody across, all asset classes. But I sense that, we're nearing a time when bad news is no longer going to mean good news for stocks. The economy has started to weaken along the fringes, not major weakness, grant you, but the labor market has seen weakness. So, yields have already pulled back very, very sharply. My thinking is yields and the dollar are close to a short-term floor, which means, further deterioration in economic data likely would be more of a negative than a positive for stocks.
And that sentiment was sort of echoed by Joe Mazzolo over at Schwab. We also asked him about the volatility here in the dollar and bond markets and what that's going to mean for stocks.
Well, just look what's happened in bonds. You've seen a real big move in the bond market. You've seen the yields kind of pull back pretty dramatically. And when you see that increase in fixed income volatility, a lot of times it spills over into the equity markets. Not always, but that's kind of been the case going all the way back to March of 23, right? When you had the regional bank crisis. And we saw a lot of that volatility from the fixed income market. That's been one of the indicators I've been following for a while is the MOVE index and how that's kind of predicated a move within the VIX. We're starting to see that again right now.
Now, to be clear, Newton, for his part, thinks while you might have that volatility continuing cross-asset, and particularly in stocks going into the election, he thinks post-election we will see a rally resume more sustainably. And Josh, I think his year-end target for the S&P was what, 5,800?
Yeah, Mark sounded constructive. He thought, Julie, the SPX, the S&P 500, he told us maybe it pulls back a bit here, 53 and change. But then we asked him what his price objective is year-end, and he did say 5,800, maybe even higher.
Yeah, and that's even with this shorter term volatility. And I will say also with regard to volatility, sort of over the summer going into the fall, we had people throwing around the word choppiness a lot, that's what they were expecting for the fall as we started to get some cooling in the economy, the attention shifting to the labor market fundamentals and whether perhaps the slowing in the economy could tip over into recession. That doesn't seem to be consensus right now, but again, that sort of back and forth causing choppiness, as you might call it, or volatility. Josh.
All right, thank you, Julie. Now let's take a look at what's trending after hours. First up, Dave & Buster's. That stock is surging after the company announced a beat on Q2 earnings, 99 cents per share compared to the street estimate of 84 cents. Restaurant and entertainment giant also revealing a beat on entertainment revenue, but a slight miss on overall revenue. That stock has dropped nearly 40% over the last 3 months. And check out shares of Petco. See what they're doing in the afters, moving about 3% here on the heels of earnings. The pet retailer reporting a narrower than expected loss for the second quarter, and same-store sales for the period unexpectedly rose, beat estimates. The company's guidance for the third quarter coming in just barely above the consensus, and that's enough to send shares higher in the after hours. That is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night.